Wish you all a happy new year. The last year was quite different in many ways. The kind of challenges and the opportunities that were provided in the face of turbulence to those who have been invested in the financial markets. The issues that dominated markets so far were mainly the trade and the tariff war between China and the US, the geopolitical tensions and the Fed policy changes, and the fears of a global slowdown. Some of these issues are in the process of getting resolved. Back home, we've seen some deterioration in the macroeconomic fundamentals. The GDP growth has decelerated to 4.5% in the last quarter. The industrial and manufacturing activity has literally come to a standstill. Retail inflation has gone up. Credit flows to the sectors like NBFC is still an issue. Even at a price, they're not able to mobilize funds. So there are several factors that are not good at present, but there are positive factors too. There is ample liquidity in the interbank market. Rates have actually come down in the market by the rates at which CDs and CPs are being placed. The sentiment is quite positive now, quite the opposite of what was actually 3 months back. There may be some more measures by the government in the budget. These are strong positive factors to support the markets going forward. Now coming to the basic asset classes, our view is invest into quality portfolios. Investors should focus on quality portfolios both across equity as well as fixed income markets. On debt, our recommendation or suggestion to investors has been to stay invested at the shorter end of the curve for more than a year and in portfolios with at least 85 to 90% AAA and AA rated papers. In the fixed income space, there have been downgrades and defaults. We are going through a growth slowdown, so it is imperative that we do extra diligence on the credit risks aspects, as the pain on account of credit risk is likely to linger on for another year. Portfolios that one chooses to invest in should be credit risk proof to the maximum extent possible. This approach has so far provided to be safe as well as rewarding. As you may be aware, we follow the enhanced efficiency model for scheme or product selection, which takes into consideration both the return-based factors and the risk-based factors. On equity, we've been focused largely on quality. Quality to us means companies which have great governance standards, which are in a secular growth phase and with proven business models, with consistency in cash flows and revenue generation as well as strong corporate governance. Invest in good quality portfolios. The best proposition will be to invest in portfolios that contain quality stocks both from the mutual fund as well as the portfolio management space. The selection will have to do much with the fund managers and the house which is responsible for the product in terms of their track record, experience and the philosophy behind the product. At Emkay, we run a blended portfolio of quality stocks called Emkay Lead. It has done very well, delivering close to 30% absolute return over the last 1 year. Please stick to the fundamentals direction set by the risk profile. Get the portfolio reviewed at least once a year. Make sure that you're not dismayed too much or swayed by the flow of news which happens daily from the market and the volatility that the market actually presents to you. We wish you a happy new year once again.